Alright, so let's talk about something that honestly is the single most important topic in trading, but it's also the one that most people completely ignore until it's way too late. We're talking about risk management. I know, it doesn't sound as exciting as finding a 100-to-1 trade or a secret indicator that's never wrong. But trust me on this, without a rock-solid risk management plan, you're essentially just gambling with your money in the Forex market. It's like driving a Formula One car without a seatbelt or a helmet. You might get away with it for a little while, but eventually a crash is inevitable, and it's not going to be pretty. The reality is the Forex market can be incredibly volatile. It moves fast, and if you're on the wrong side of a trade without any protection, your entire account could be wiped out in a matter of minutes. This isn't an exaggeration. I've seen it happen time and time again. That's why having a plan isn't just a suggestion, it's a requirement for survival. It's the foundation upon which any successful trading career is built. It's what separates the professionals who do this for a living from the amateurs who blow up their accounts and then complain that the market is rigged. The difference is discipline and a set of rules. That's exactly why I wanted to make this video. My entire approach, what I call the AP price analysis method, is built on a framework of managing risk first and foremost. Before we even think about profits, we have to think about protecting our capital. The method itself highlights several key reasons why every single trader, whether you have $100 or $1 million in your account, absolutely must have a defined risk management policy. It's non-negotiable. So, smash the like button for the YouTube algorithm and let's get into why this is so critical. So, the first and most obvious reason for having a risk management policy is to protect your trading capital. This sounds simple, right? Of course you want to protect your money, but you would be absolutely shocked by how many people jump into the Forex market without a real plan to do this. They see a currency pair moving, they get a tip from some group, and they throw a huge chunk of their account at it, hoping for the best. That is not a strategy. That's a lottery ticket. Your trading capital is your business inventory. Without it, you are out of business. You can't make any more trades. You can't generate any more profit. It's gone. The Forex market is known for its volatility. We're talking about a market that trades trillions of dollars a day, influenced by global news events, central bank announcements, and massive institutional orders. These factors can cause prices to whip around violently and unpredictably. A single tweet or an unexpected economic data release can send a currency pair soaring or plummeting hundreds of pips in seconds. If you don't have a predefined plan for how much you're willing to lose on that trade, you're exposing your entire account to that volatility. A good risk management plan acts as a firewall, protecting the bulk of your capital from these sudden market infernos. Think of it this way. A professional poker player would never go all in on the very first hand, no matter how good it looks. They know the game is a marathon, not a sprint. They manage their chip stack so they can survive the bad beats and stay at the table long enough for their skill to pay off. Trading is exactly the same. Your capital is your chip stack. Protecting it with strict rules like only risking 1% or 2% per trade ensures that 1 or 2 or even 10 bad trades in a row won't wipe you out. It guarantees you can stay in the game and wait for the high probability setups to appear. The second massive benefit of risk management is that it controls your emotions. Let's be real, the two biggest emotions that destroy traders are fear and greed. Greed makes you jump into a trade without proper analysis because you have FOMO, fear of missing out. You see a currency pair rocketing up and you think, I have to get in on this. So you buy, probably right at the top, without a plan. Then fear takes over when the trade immediately turns against you. You freeze up. You don't want to take the loss because you hope it will turn back around. So you watch it go deeper and deeper into the red, blowing past the point where you should have gotten out. A solid risk management policy is your psychological shield against this. It forces you to be logical instead of emotional. When you have a clear rule that says, I will place a stop-loss order on every single trade, it takes the guesswork out of it. You've already made the decision with a clear head before you even entered the trade. You've already decided what your maximum acceptable loss is. So when the price hits your stop loss, the trade is closed automatically. There's no room for hesitation, no hoping, no praying for it to come back. The decision was already made, and the system executes it for you, protecting you from your own emotional reactions. Similarly, having a plan controls greed. If your plan includes a take-profit target based on a 1-to-2 or 1-to-3 risk-to-reward ratio, it prevents you from getting greedy and holding on to a winning trade for too long, only to watch it reverse and turn into a loser. Your plan dictates when you enter, where you place your stop loss, and where you take your profit. By defining these parameters before you risk any money, you remove emotion from the equation during the trade itself. You are no longer making impulsive decisions in the heat of the moment. You are simply executing a predetermined, logical plan. This is how professionals trade. This brings me to the third point, which is ensuring your long-term survival as a trader. Here's a hard truth that a lot of trading gurus won't tell you. Even the most profitable trading strategy in the world will have losing streaks. It's a statistical certainty. You could have a system that is profitable 70% of the time, but you could still experience 5, 6, or even 10 losing trades in a row. It happens. It's called a drawdown period. And every single trader, from a beginner to a hedge fund manager at Goldman Sachs, goes through them. Now the question is, can your account survive that losing streak? If you're risking 10% or 20% of your account on every trade, a string of 5 losses will completely devastate your capital, if not wipe it out entirely. After a 50% loss, you need to make a 100% return just to get back to where you started. The math is brutally against you. This is where most aspiring traders fail. They have a few bad trades, their account gets crushed, and they give up, convinced that trading is impossible. They were knocked out of the game before their strategy even had a chance to play out over the long term. Risk management is what allows you to weather these inevitable storms. If you are only risking 1% of your capital per trade, a losing streak of 10 trades in a row means you've only lost 10% of your account. That's not fun. Nobody likes to lose money, but it's a manageable loss that you can easily recover from. It keeps you in the game. It allows your profitable strategy's edge to manifest over a large sample size of trades. Surviving the drawdowns is the real secret to long-term success. It's not about finding a magical strategy that never loses. It's about having a risk plan that is robust enough to handle the losses you will inevitably face. Let's dig a little deeper into the concept of drawdowns, because this is where risk management really shows its value. The fourth key reason to have a policy is to actively reduce the impact of these drawdowns on your account equity. A drawdown is the peak-to-trough decline in your account value. For example, if your account goes from $10,000 up to $12,000 and then drops back down to $9,000, your drawdown is $3,000 from its peak. This is a critical metric because large drawdowns are not just financially damaging, they are psychologically devastating. When you let a single losing trade run far beyond your intended stop point, you are creating a massive, unnecessary dent in your account. Let's say you have a $10,000 account and you risk $100 or 1% on a trade. If it hits your stop, you're down to $9,900. No big deal. But if you don't have a stop, and you let that losing trade run because you're hoping it will come back, it could easily turn into a $1,000 loss. Now you're down to $9,000. You've just experienced a 10% drawdown from a single trade that should have only been a 1% loss. This is an unforced error, and it's entirely preventable. By strictly limiting the maximum loss on any single trade, you are putting a hard cap on how much damage any one bad decision can do. You are effectively smoothing out your equity curve. Instead of having a chart of your account balance that looks like a violent roller coaster, you create one that has small, gentle dips during losing periods. This makes the recovery process much, much easier. As I mentioned before, recovering from a 10% loss requires an 11% gain. Recovering from a 50% loss requires a 100% gain. By keeping your losses small and controlled, you ensure that you never dig yourself into a hole so deep that you can't get out. Finally, the fifth reason, and this is what ties everything together, is that a strict risk management policy improves your consistency. Consistency is the holy grail of trading. It's not about that one lucky trade that makes you a 50% return. It's about being able to generate reliable, predictable results month after month, year after year. Wild swings in your performance, where you make 30% one month and lose 40% the next, are a sign of undisciplined, inconsistent trading. It's a recipe for long-term failure and a whole lot of stress. When you stick to a rigid risk policy, you are standardizing a crucial variable in your trading. You know that no matter what happens, your losses will be contained to a specific, predefined amount. This creates a stable foundation from which you can operate. It allows you to evaluate your trading strategy's performance objectively. If you have a series of losses, you know it's because your trade selection might be off, not because you let one loser wipe out 10 winners. It allows you to make systematic adjustments to your strategy instead of just reacting emotionally. Over time, this discipline builds a track record of consistent behavior, which leads to more consistent results. You start to see your trading not as a series of individual gambles, but as a business operation with probabilities and expected outcomes. You know that if you execute your plan with a positive expectancy over and over again, while keeping your risks fixed and small, the profits will take care of themselves. This is the mindset shift from an amateur gambler to a professional trader. It's not about being right on every trade. It's about having a system where your winners are bigger than your losers and executing it with relentless consistency. So, to wrap everything up, having a risk management policy isn't just a nice to have. It's the bedrock of a successful trading career. It protects your capital from the market's volatility. It prevents your own emotions from sabotaging your account. It ensures you can survive the inevitable losing streaks. It minimizes the impact of drawdowns. And it ultimately leads to the consistency that every trader strives for. Without it, you're simply not giving yourself a fair chance to succeed in this business. It's really that simple. The key components are straightforward. You need rules for your position sizing, which means how much you risk per trade. You need to use stop-loss orders on every single trade period. You need to define your minimum acceptable risk-to-reward ratio to ensure your winners are bigger than your losers. And it helps to have rules for leverage control and daily loss limits to prevent you from overtrading or revenge trading. All of this comes down to one thing: having a trading plan and the discipline to follow it without exception. To make this tangible for you, here is a simple but powerful rule you could adopt right now. I will risk no more than 1.5% of my account on any single trade, with a minimum 1 to 2 risk-to-reward ratio, and I will stop trading for the day if my total losses reach 3%. A rule like this is clear, it's measurable, and it covers your risk on a per-trade basis and a daily basis. It's a professional approach. I really hope this has been helpful. Thank you so much for watching. Don't forget to smash the like button. Subscribe if you haven't already.